Remember we had like over 850,000 jobs like erased because the data that gets collected by the Bureau of Labor Statistics then gets cross-referenced over the next year. It takes a while for this stuff to come out. And by the way, that reconciliation is going to be happening here next month. The last jobs report had 355,000 people leave the workforce, like out in 1 month. Now, in 2 months, that number is 723,000 people.
Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Corona, California. Merry Christmaka. We have Christmas and Hanukkah coming up on the same day. It's been like 100 years since that's happened. Elliot Eisenberg, the Bowtie economist, just put out a pretty cool note about when Hanukkah is, and there's a leap month in the years. And anyway, it's a festive week. We're actually closed tomorrow. I didn't know. I thought we were working tomorrow. So, yeah, maybe I need an admin. I hope you all have a wonderful week with your families. I read an Axios article this morning. It's very sad. Which is a left-leaning newsletter, but there's some good reporting. But it said that people are, I won't alienate anybody. Listen, one party was like 5 times more likely to not hang out with family on the holidays because of their political views. Let's exercise some emotional intelligence, as my good friend Steve Scanlon from Rewire and Jay Cinnabel, when we study metacognition together, we are looking for ways to be better. And so, anyway, that's my message. Appreciate all the wonderful blessings and great notes and awesome content and just conversations throughout the year. Don't worry, I'll be back Thursday. So let's get cracking. All right, so I did have a video last Thursday after the Fed spoke, but then the PCE came out. And that's the personal consumption expenditure. That is the Fed's preferred measure of inflation. And so isn't it crazy that at the middle of the day on Wednesday and then all day Thursday, everyone's like, that 2% target inflation, it's sticky, it's not going anywhere. I mean, I've got trading services that like I pay money to get stock tips and advice for. I'm not a financial advisor. I am not responsible for your losses, only your profits. And these people don't dig in to the inflation. And so I'm not here to make predictions, but I just want to point out some stuff. And I'm not looking for confirmation bias because I do understand that we are moving down, more slowly with our disinflation, right? So, but there's a reason. And there's only like 3 different groups that I listen to that actually dig in line by line in these reports. I mean, Barry and Dan Habib at MBS Highway, they're the best. Tom Lee at Fundstrat, with their insights at Fundstrat Advisors, he's on CNBC all the time. I pay for his service as well. He does it. And Ivy Zellman, with Zellman Associates and their team, they do it, which they're now part of Walker Dunlop. And I've never seen anybody who says inflation is sticky and it's here and it's not going away and we're going to have 5% 10-year yield. I've never seen anyone break down any of the numbers that say that. And so that to me is telling. And so what I love that when you see these breakdowns, you see that the last couple months, housing shelter inflation is not rising as fast as it has been. So that's what disinflation is. It's not deflation. It's not a negative number. It's still a positive number, but it's less of a positive number. So when you look at an index, you've got 12 different numbers, monthly numbers, and the one from 12 months ago gets taken out and replaced with one right now. We all know that, owner's equivalent rent, new rents, as pointed out by Ivy Zellman and team, new rents are coming down. Shelter costs, in general are coming down. There's slowing home price appreciation. We are in the industry. We literally read the stuff every month that we could see, where home prices are at. So there is a lag effect, and it's finally taking place. And those numbers for December, I would say January, February, March. Remember Q1 of this year that was like kind of an abnormally high and unexpected spike in inflation for shelter costs. Well, now those higher numbers are going to be replaced with, what we're seeing right now with currently high rates and disinflating shelter numbers. And so I'm really bullish on inflation coming down. The Fed, when they say there's going to be only 2 cuts next year, they can't see that far. And they have to make a hawkish cut like they did the other day because they need to control the animal spirits of the markets. If the stock market rips, which it still might in light of their meeting, did you buy the dip? We might be in a dip buying moment right now. They're trying to temper exuberance, right? Because they can't just be like, "Hey, we see what Barry and Ivy and Tom see. We think it's coming down." So anyway, and by the way, I want to throw in a kind of a new thought because I know we talk a lot about like the Fed and inflation reports, but I read one of the Gilder report. It's one of the subscriptions I pay attention to for about 6 years, and inflation is really driven by government spending. I mean, that is really that fiscal policy, which is kind of unknown, where it's going to be next year. There's the threat of tariffs and, but there's also going to be deregulation and pro-business and maybe tax cuts, right? So, like no one really knows. And I think the Fed, which, the board is overwhelmingly liberal, and it's not a shot. I'm just calling it like it is. It is what it is. Even though Chair Powell himself is a registered Republican, they are being tempered because they're not sure where this new administration is going to be when it comes to fiscal policy. But we don't have a supermajority in the Congress. So, I mean, look at what just happened. We finally passed a continuing resolution. There was a version that came out last week. It got shot down. And then after it got shot down, the second version that came out was largely, approved publicly by, Trump and even Elon, I guess. But then that got shot down by the far-right group within the Senate. And so a third version came out and got passed on Friday afternoon. So passed Congress, went to the desk, and Biden signed it on Saturday. So he also pardoned 37 people on federal death row, And so, lots of stuff going on here at the end of the administration. So it's very busy, but that fiscal policy is very important to inflation. I mean, we had 0% monetary policy from the Fed for like a decade or more. Why didn't inflation just run endlessly? I mean, there's more to it, right? And so, one of the most impactful things that could happen next year regarding inflation and fiscal policy would be an extension of tax cuts that are already in place from the first Trump presidency, and any other reduction in capital gains tax or any other taxes. And so how will that be offset with our budget? We already don't collect enough taxes to pay for the money we spend. Are we going to rein it in? Are we going to spend more? Are we going to spend less? Are we going to tax more, tax less? It's a gamble, right, to have tax cuts and cap gains tax cuts and hope you grow your economy's way out of it. And so, healthcare, it's growing at 7% a year, and GDP is, thankfully, at 3.1%. But the Fed estimates GDP to be between 2 and 2.5% all next year. And we're, at 3.1 now, maybe 3.2 for Q4. And so how much, slower is this economy going to get next year? Not bringing enough revenue off that GDP to offset all these fiscal policies, such as healthcare, tax cuts, all these other things. So there's definitely some uncertainty next year. And government spending, again, by and large, is the bulk of the cause for inflation. The Fed is always reacting to that. So the Fed, again, you can say they had zero, interest rate money like we did during COVID, but they did for over a decade. And how come inflation wasn't running even higher than it is right now? So the Fed is usually reactionary, and that's just how it is. So anyway, enough about that. Just an interesting thing to think about. It was interesting to see in the PCE data that wage inflation is kind of in check, and that's a good thing. But as inflation, so goes the Fed's interest rate policy and the market and your portfolio. And so, did you buy the dip? Did we have a dip last week? It's interesting when you see the stock market sell off like it did at the end of the day, on Wednesday and then going into Thursday and then rebound Friday. A lot of that's just positioning, right? And so same thing with bonds and treasuries and the 10-year yield going up to 4.59 today. There's end of year positioning. There's a lot of money flowing in from money markets. Remember, at the beginning of the year, it was like $7 trillion in money market, where the Fed funds, they keep cutting the rates, which means they're making less to sit there and earn that value. So now there's $6.5 trillion. I mean, something like $180 billion of inflows into ETFs out of money market accounts just in this month. That's massive. So money is coming off the sideline and it's positioning itself into the stock market, which, of course, institutional traders, trading bonds. It's like they're getting good yields as these stock prices. Maybe some of it's bubblicious and some of it's not, but they demand a higher yield to pay for and finance our government's debt and deficit on a treasury yield. So there's a lot of mechanics at work, and the end of year is very interesting. Will there be a Santa Claus rally? Will it happen this year? Will it happen going into next year? I don't know, but there's some, a lot of times, there's some mean reversion, some profit taking, selling some stocks to then be able to go into another position, or maybe you're over leveraged. I have a trader account. It's like a small one, but it's like all on margin, right? So it's just all leverage. And so sometimes I'm over levered and I got to trim some positions. I try and do it at a time when I choose to, not when the market sells off and chooses it for me, but it's just fun. It helps me kind of understand the flow of money. Interactive broker, I love it. And so, a lot of that's going on right now, but this could be a dip buying moment. Some of these stocks that you see touch certain highs, they come back, they do a mean reversion, and then they kind of march their way back into it as long as earnings supports it. And earnings growth next year is, in double digits, so 12%, 15% earnings growth. We'll start Q1 earnings growth season kicking off here in just a couple weeks. So we'll have a whole nother catalyst for the stock market, which will be interesting to watch. So not just the Mag 7. By the way, some stocks got kicked out of the S&P, and there's a rebalance, NASDAQ 100, excuse me, and then were replaced by some other ones. Let's see, Palantir, which I'm in, MicroStrategy, which I'm in, and Axon, which I'm not. Replace Illumina, which I'm not in, and Super Microcomputer, which I'm in, and losing my ass, and Moderna. And so you have this QQQ, right? It's like a NASDAQ 100. There's like these ETFs with a name. It's just the top 100 in that NASDAQ, and they rebalance it, right? And so, okay, these three are kind of losing. These three are winning. We're going to swap them out. So when these stocks become part of an ETF, they just get bought by all these passive investors and their money managers. Look at Apple running right now. Like pretty much every ETF on the planet has Apple in it. So I don't know what Apple really did, other than being one of the best businesses in the world, but they're approaching $4 trillion. Tons of free cash flow. They have a huge install base. There's this like supercomputer refresh. They're putting AI in their phones right now. So is it worthy of a stock running up 30%? I don't know, but don't fight the Fed. Don't fight the trend. Look, just never go broke taking a profit. So again, I'm not a financial advisor, but man, there's some good gains going on. It's not too late. Just leg into it. Okay, population growth. Very interesting topic that Ivy Zellman and team speak about. Go back and look at From Cradle to Grave is a very interesting article they put out. Gosh, it's been like over 3 years now, where they talk about population decline because of our birth death rate, which is something we're going to start to see in these jobs reports. See if they start to unwind some of this birth death modeling in the BLS reports. Anyway, back on point, our population grew by 0.98% this past year through June. Okay, so and then 2 upward revisions for the prior years before, all due to immigration. So our population and our working class, society is really getting a lift there, and so we'll be interested to see what happens with immigration going forward. Ivy Zellman and team, they have an annual growth of the next 5 years averaging only 0.5%, so half the growth. So that will be interesting. By the way, all these stock companies and AI companies, which I love where AI is going, it's here now, it's in our business, it's everywhere. I mean, I could, talk about it for ages, but who's going to power it? Are we going to really tap into our natural gas? Do you know how much natural gas we have in America? 625 trillion cubic feet underground in America, ready to consume. Okay, so that's enough gas to produce 30 gigawatts for the next 2.7 billion years. So at an extremely low cost. And then we've got outside investors, investing. Masayoshi Son from SoftBank, who is a renowned venture capitalist, has pledged to put $100 billion invested in America, plants and companies and this and that. And he's sitting there at this podium with President-elect Trump, and Trump's like, I'm going to get him to do it $200 billion. It's kind of awesome. Like, just strong arm this guy who's got money. And he said it too. He could do it. So I don't know. Maybe we'll get some more money here and get some investment going. Anyway, I think we're in a good spot. Rob Christman, legendary Rob Christman. I love making him blush. He travels more than anyone I know. It's insane. Put out third quarter 2024 showed 97.4% of mortgages were current and performing, and that's just a slight increase from 97.3 a year earlier. So we're in a good spot, I think. So anyway, as we roll into Christmas and the rest of this week, we're in a good spot. That's a lot of data. I know I just dumped it on you. I will get back to you in a few days with some more stuff that I'm reading about. Have a wonderful holiday and relax and chill. The Dalai Lama said that if you're angry, anger is stemming from an overinflated sense of self-worth. Think about that. Don't be angry. Cheers. Hey, it's KP coming to you live from Corona, California. 8:30 on the West Coast on Thursday night, the day after Christmas. Hope you all had a wonderful start to Hanukkah and Christmas and soon to be the new year. So we are working here. I'm getting a jump start on 2025. Just as my boy Matthew Van Fossen said on LinkedIn, saw some pretty cool posts on LinkedIn earlier when I was browsing around. I saw my good friends over there at Zactus, good old Galucci and Greg Holmes, talking about ways to help with our credit costs, which my friends David Licken, who was interviewing Taylor Stork, and Greg Scher, we're talking about a host of topics, and of course the insane credit costs came up, and so these guys can help you. Then Aaron Montel was commenting on my last LinkedIn post. We had a good conversation, you guys, so check it out. It's pretty interesting, and it made me kind of think of something to talk about here. What the heck's going on with the Fed? What's going on? Like, why is the 10-year Treasury shooting up so much and hurting interest rates? Well, I just want to add a couple pieces of flavor here. First of all, the last 2 weeks of the year is kind of light trading. So all the institutional traders. Now, a prior life, I would have said all the big boys have gone home, but the big boys are back. But I can't say big boys anymore because there's some big women up there on Wall Street too. I like listening to them. Ivy Zellman, Kathy Wood. So the big institutional traders, they're rocking it. I mean, they are the ones that set the tone. But there's nobody that sets the tone more than the Fed, the Federal Reserve, who just had their meeting last week. So we've got light trading. There's some tax loss harvesting going on in the stock market. Some people kind of moving, positioning around. A lot of the big fund managers, not just family fund offices, but really big fund managers, they're coming back next week. We've seen anywhere from $6.5 to $7 trillion of money on the sidelines in this past year. And we're seeing big inflows coming into the markets, mostly into ETFs, exchange-traded funds, which are a nice tax advantage way to trade a basket of securities. If you can't go trade 20-year treasuries yourself because you're not a bond trader, you could buy the TLT, which is one that Aaron and I talked about, which I trade quite heavily over the last couple of years. I am not a financial advisor. I'm not responsible for your losses, only your profits. But the flow of money and wealth creation will really kick into high gear in January. Now, that's not to say that there isn't activity and stuff going on, but just take what's going on right now with a grain of salt. So, like, for example, today on, basically no real news, the holidays and just, I don't know, maybe fear of the unknown of what's coming up, whatever the Fed has talked about, which I'm going to get into in a second. It's very interesting. They're not solely data dependent anymore. They broke that trend, and I'm going to talk about that. And so, you see a 7-year auction, Treasury auction went off today, and then that brought the 10-year Treasury yield back down to a calmer level. And so I'm not saying that's the start of a trend, but we saw earlier this year where the Treasury market wanted to go based on data. And it's been, as Logan Monoshami likes to say at Housing Wire, labor over inflation. But up until the last Fed meeting, it was labor, labor, labor. And then he made it sound like it's labor and inflation being looked at equally and in balance. But why is that? You got to dig deeper. And so I mentioned this on my last video, and I've been mentioning it for years, but the biggest cause of inflation is the government spending. I mean, by far in the world. And our government and our economy, which I think we're like a $32 trillion economy, something like that now. 33, I don't know, lose track. Maybe I mix that up with our debt, which is 27 trillion and growing. Somebody correct me on those numbers. But our government spending is unknown. We're going into a new administration. And so what's interesting is there's all this fear of tariffs and deportation and all these highly inflationary potentially policies that could create inflation. I'm not talking about inflation from like the PCE and the CPI, which I'll get into that in just a second. It's been improving. Clearly, the data is showing it's improving. And so it's the fear of the biggest cause of inflation that people are worried about, and that's the government spending. I'll just posit a contrarian thought. The last time the Trump administration went into office, they were highly pro-business and were into deregulation, which is interesting because it grows the economy and creates more wealth and more velocity of money. So, and of course, there's tax cuts that was implemented during that administration, which expire next year and could be extended, and that's highly pro-business friendly. So I think there's a lot of fear of the unknown, and the reason I bring that up is not to get political. It's because the Fed brought it up. The Fed voting members, and you can, if I listen to every Q&A session after every Fed meeting. It's amazing. And Chair Powell said a lot of the members were worried about this new administration and tariffs and the immigration policy. So that's not data dependent. That's fear of the unknown. There's no data there, but they took that into consideration in taking, for now, 2 rate cuts off the table next year of 4, and only saying they're going to do 2. So, and if you listen to every single one of Chair Powell's Q&A sessions, he says all the time, hey, we at the Fed only control monetary policy. We don't control fiscal policy. That's up to Congress. We are on an unsustainable path. The path is unsustainable. We are going down a path of unsustainability. He says it over and over and over. It's not the Fed. He knows where inflation comes from. It comes from the biggest spender in the world, the U.S. government, our taxpayer dollars. So your votes matter. You're going to have to wait 2 more years if you don't like who you voted for. I will say I was slightly encouraged to see with this continuing resolution that got kicked around last week, up until the last minute, of course, on Friday, that huge stack of bill came out. And, whether you want to give Elon Musk and X, formerly known as Twitter, a lot of credit, but, this big bill got shortened down to that and got kicked to a second version. It did not pass in the House. Typically, these budgets and continuing resolutions make their way through the House first. And then the second version, which both Elon and Trump said we like, got denied again. So a third version. So there's a thrifty spending segment of the House that I'm encouraged may keep our government in check. And so the third version passed the Senate late Friday night, and then President Biden signed it on Saturday. So we kicked the can down the road to March. So every new administration has like this 90-day grace period where, they have this mandate and they won the popular vote and swept all the counties and states and blah, 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 and, we're badass. And so we're going to do whatever we want. So we'll see what they do in 90 days, right? And so, again, I'm not trying to take sides. I just watch these things, ever since, really, the Reagan era, and just watching how politics works. Of course, I was a little kid back then, but, I've been formulating my thoughts over the decades, and, this is what's going to happen in the first 90 days. Well, by the way, before that 90 days is up, this new administration is going to have to figure out a way to either do another continuing resolution or come up with a budget. And that matters to inflation. And so it's not going to get done by the January Fed meeting. And that's okay. The Fed doesn't have to show their cards again until their next meeting, which, if I take a quick look at, oh boy, sorry, I don't have it up here, but I can't remember. It's like 6 weeks after January 25th, I believe. So then they have another dot plot. So a lot of data will come out in the next 12 weeks. I guess as of today, it's only 11 weeks from now. So you don't believe me about labor over inflation? Let me talk about some of the data points for labor and inflation, which may blow your mind. You may not have known this. Okay, so the housing, if you're someone that just reads the headline numbers of reports, you're not doing your homework. You're not digging in. And so you really need to. It's important, especially if you're going to go out and espouse opinions about where you think things are going. like I do. And look, we're all entitled to our opinion. I'm just saying, the research matters. And so the household survey and the establishment survey, those are two things that make up the jobs report, which the next one we're getting next week, next Friday, the December jobs report. And there's some lag in data collection, especially because of the holidays. It's typically the second half of November and the first half of December data gets collected in the second half of December and then reported on the first Friday of the following month. So it's not like calendar. It's hard to collect all the data. I mean, remember we had like over 850,000 jobs like erased because the data that gets collected by the Bureau of Labor Statistics then gets cross-referenced over the next year with each state's records of, their employment insurance numbers and stuff like that. So, it takes a while for this stuff to come out. And by the way, that reconciliation is going to be happening here next month. And so the last jobs report had 355,000 people leave the workforce, like out in 1 month. Now, in 2 months, that number is 723,000 people. Okay? That's not a strong labor market, all right? There's also something called the U6 unemployment rate, which the Bureau of Labor Statistics puts out. This is like the best all-encompassing number you can come up with. It's an unemployment rate for people that are discouraged or just leave the workforce or give up or whatever the case may be. And I think I saw, is it 7.4%? Okay, so it's up through November. The long-term average is 10.10, so it's not like we're like even there yet. We have a pretty healthy, robust labor market, but it's definitely soft around the edges, which is why I still think to the Fed it's labor over inflation if you're just looking at the inflation reports, right? So let me give you some inflation reports you may have glossed over last week, which I think are extremely important, okay? So the Empire State Manufacturing Index, survey prices received, which is a good proxy for inflation. It plunged in December to 4.2, its lowest level since July 23. The same index in New York Fed Services Survey, another inflation proxy, fell to 11.7 this month. The lowest reading since February of 21. Okay? That's not rising inflation. The S&P Global Composite PMI report, it found that average prices charged for goods and services only rose very modestly in December, and they're climbing at their slowest pace since prices began rising in June of 2020. June of 2020. February 21. Now, we also know the owner equivalent rent in the CPI had its second largest drop month over month ever. Okay? That's not rising inflation. That's not sticky inflation. Okay, so you have to look at these components that are in there. And so I'm going to keep doing it if you don't want to. But, just be careful about like these big giant opinions you throw out there until you really dig in. And we're all learning together. I'm learning all this stuff. Like, I don't know this stuff. I freaking learn this stuff by reading all this shit. So, pardon my language. Okay. So, the cracks in the labor market, I think are the reason the Fed's still cutting. And what was interesting Aaron Montel, I went back and I checked out a couple of his posts, and he talks about the bear steepening curve. Remember we had an inverted yield curve in the past where the 2-year was higher than the 10-year. And it's not supposed to be like that. You're supposed to get paid more for having your money out there longer, like 10 years. So we had an inverted yield curve. That is typically a sign of a recession to come. And then when it uninverts, that means we're even closer to a recession. We're going to go into a recession at some point. I don't know when, I don't know how, but it's going to happen. That's just the nature of business cycles. So I'm not on recession watch yet. But what's interesting is we had an uninverted yield curve because both the 10-year yield and 2-year yield ran up. The 10-year yield is just running up faster. So will they roll over and fall down as we get more data and more certainty going into next year? Unfortunately, we lock loans every day in this business, and it sucks when, volume is light during the holidays in January and February, but in 60 days, spring purchase business will be coming back in. Just hang in there and keep grinding. It sucks, having these phone calls and seeing these emails. Don't worry. We're watering the shit out of our grass here. There is a cuss again. We are watering our grass. Keep watering your grass where you're at. The grass is not greener. I promise you. Keep watering. Okay, so let me talk about, there's no evidence of credit deterioration in the market. High yield, junk bonds, very tight treasury spreads. So let's talk about wealth creation. Apple stock, for example. I'm not a financial advisor, but it's running right now. Why? What's happening? What's going on? It's in every ETF. There's a lot of money flowing into the markets, and Apple is one of the biggest components. It's about to be a $4 trillion company, market cap. Boomer widows, I talk about a ton. There is they've been creating wealth. We have $152 trillion of wealth in this country. It was only $105 trillion a decade ago. And boomers have 50% of that. In the next 25 years, they might have 80% of that wealth. So, get in the game, get a house, get property, get some stocks, deal with your financial advisor. My boy Keith Nichols out there at Carrera Capital, get with them. Y'all have a good one. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.